Have you ever looked at a stock and wondered if it was actually cheap or just looked cheap on the surface? That question alone has cost investors countless missed opportunities and painful losses. Most people rely on one single number to judge a stock, and that is a huge mistake. Today you are going to learn the exact ratio that Peter Lynch used to generate 29% annual returns for 13 consecutive years. By the end of this video, you will know how to calculate it, how to use it correctly, and a few things most investors completely overlook that can make this ratio even more powerful. Stick around because this could genuinely change the way you look at stocks forever. Let's start at the beginning. Peter Lynch is one of the most respected investors in history. He managed the Fidelity Magellan Fund and turned it into a money-making machine that crushed the market for over a decade. His secret was not complicated technology or insider information. It was a simple but powerful formula that anyone can use. Before we get to his masterpiece ratio, we need to build the foundation. The price-to-earnings ratio, or PE ratio, is the starting point for almost every stock valuation conversation. You take the price of a stock and divide it by its earnings per share. If a company trades at $40 and earns $4 per share, the PE ratio is 10. Simple. The lower the PE, the more you might be getting for your money. But here is the problem. A low PE does not automatically mean a stock is a bargain. A slow, stagnant company might have a PE of 8, while a fast-growing company might have a PE of 25. Which one is actually cheaper? That is where the PE ratio fails you, and that is exactly why Lynch went further. Enter the PEG ratio. This takes the PE ratio and divides it by the company's earnings growth rate. So if a company has a PE of 25 and is growing earnings at 25% per year, the PG ratio is 1.0. If another company has a PE of 8 but is only growing at 4% per year, the PEG ratio is 2.0. Now the picture looks completely different. Lynch's rule of thumb was that a PEG ratio below 1 suggests the stock could be undervalued relative to its growth, and above 1 might mean you are overpaying for that growth. Now here is where it gets interesting. When using the PEG ratio, you have a choice to make. Should you use trailing earnings and growth, meaning what already happened, or forward estimates, meaning what analysts expect going forward? Trailing data is based on reality, but markets are forward-looking. The honest answer is that forward estimates are generally more useful because stock prices reflect future expectations, not past performance. However, forward estimates can be wrong, so using both gives you a more complete picture. If a stock has a blank or negative PE, as sometimes happens when a company has a rough year or is temporarily unprofitable, using the estimated forward PE is a perfectly reasonable approach. Just make sure you are aware that you are working with projections, not confirmed results. Good! But Lynch still was not satisfied with PEG alone. He added one more variable that transforms everything. That gives us the PEGY ratio, and this is his true contribution to individual investors everywhere. The PEGY ratio takes the PE ratio and divides it by the earnings growth rate plus the dividend yield. So if a company has a PE of 24, is growing at 20% per year, and pays a 4% dividend, the PEGY is 1.0. Just like PEG, a PEGY below 1 suggests the stock may be undervalued, while a number above 1 suggests caution. The lower the number, the more attractive the potential opportunity. Why does the dividend matter so much? Because while you are waiting for a company to grow, and for the stock price to reflect that growth, dividends are real cash being returned to you. Lynch believed you should be rewarded for both the growth you are betting on and the income you are receiving along the way. It creates a more honest picture of total return potential. Now, some investors take this even further by also including the buyback yield in the denominator alongside the dividend yield. Share buybacks are essentially another way companies return value to shareholders. When a company buys back its own stock, it reduces the share count, which increases earnings per share over time. Adding buyback yield to the formula gives you an even more complete view of shareholder returns, especially for companies that prefer buybacks over dividends. It is a thoughtful addition that makes the ratio stronger and worth considering. One question that comes up often is how to actually calculate the earnings growth rate. There is no single perfect answer, but a common approach is to look at a 5-year historical growth rate as a baseline. This smooths out single-year anomalies and gives you a realistic sense of what the business has delivered over time. You can also look at forward analyst estimates to get a sense of where growth is expected to go. Using annual figures is generally more stable than quarterly numbers, which can be noisy. The key is consistency. Whatever method you choose, apply it the same way across every stock you compare. Now, a fair and important point about this entire approach. In periods where market valuations are historically elevated across the board, value-focused metrics like PEGY can struggle to find obvious opportunities. Many stocks will screen as expensive. That is not a flaw in the formula. It is actually the formula doing its job by telling you the truth. The beauty of having a tool like this is that when a market cycle turns and prices reset, you will already know exactly what to look for and how to evaluate what is genuinely cheap versus what just looks cheaper because everything fell together. Lynch himself used the PEGY approach to identify extraordinary companies like Dunkin' Donuts, Taco Bell, and Home Depot when they were still growing and under the radar of Wall Street. The formula was not the only thing he used. He looked at the business itself, the competitive advantages, the risks, and the overall financial health. Numbers on a screen only tell you so much. You have to understand what the company actually does and whether it can sustain that growth. So here's the simple framework to walk away with today. Start with the PE ratio to get your baseline. Then calculate the PEG ratio to see if the growth justifies what you are paying. Then calculate the PEGY ratio to include dividends and get the most complete picture. Consider adding buyback yield to the denominator if the company regularly repurchases shares. And finally, always use both trailing and forward figures to get a full perspective, knowing that forward estimates carry more weight in how the market actually behaves. No single ratio makes a buy or sell decision for you. PEGY is a powerful screening tool, a way to quickly sort through opportunities and focus your attention. But the real work comes after the number, when you dig into the business and decide if you actually believe in it. Here's what I want to ask you before you go. When you are analyzing a stock, do you lean more toward trailing data because it is proven? Or do you prefer forward estimates because they reflect where the company is heading? Drop your answer below because there is genuinely no wrong answer, and the discussion always brings out interesting perspectives from this community. If you learned something new today or found any part of this valuable, go ahead and hit that like button, subscribe if you have not already, and ring the bell so you never miss the latest investing insights. The more you understand these tools, the better equipped you are to make smarter decisions with your money. See you in the next one.